Welcome everyone to Jim Dalton's presentation, How to Monitor a Trade for Continuation. It's Thursday, July 6th, high noon East Coast time. We'll go for about an hour. We welcome your questions. We are recording this webinar and we will have it posted at jdaltontrading.com within a couple of hours once it's over. Okay, so Jim and I want to thank you all for being here. It's great to see you and enjoy the presentation. Okay, any questions you have about our upcoming course starting on Monday, July 10th, the Mastery Series Course 2, you're welcome to email us or give us a call. There's contact information at jdaltontrading.com. Okay, and enjoy the presentation, and I'll turn it over to you, Jim. Hello.
Well, thank you very much. All right, there's actually a couple of very interesting examples when we talk about monitoring a trade for continuation. The first statement that I want to make is that the structure of the market profile provides context to price. Remember, price is simply an advertising mechanism. Unless you break the habit of following price, it's going to be very difficult to make a good start and be successful in trading. I want to start off, I'm going to show yesterday first, and then I'm going to come back and I'm going to talk specifically about today and what is going on today. I'm going to start by splitting out yesterday's profile. We came into yesterday. Let me add one more thing in here to make it real. Okay, we came into yesterday with overnight inventory being short, and we're calling it electronic trade, and we're including within that any electronic trade that took place from Monday's settle. So we came into yesterday and overnight inventory was short. The expected reaction when overnight inventory is short is to see a counteraction. By counteraction, that means correcting inventory from overnight. So if overnight inventory was short, the counteraction would be a rally. We got that counteraction yesterday, and the market went up and formed a P formation. A P formation communicates to us that what we saw was short covering versus a more potent combination of new money buying and short covering. So we got the expected action relative to overnight inventory. The last value area we were using was Monday. I'm going to mark let me get this out of the way. I'm going to mark the low of Monday's value area. It's the red line right across here to 24.2850. As the market was rallying, you say we got the P formation. One of the things that we do, we talk about monitoring for continuation, but we also talk about letting the trade come to you. They go hand in hand. If you can clearly monitor for continuation, then you'll have a better perspective of what may be attractive trades. For those that are clients and are in the last of the Mastery Series, which starts on Monday, you will see that we have a one-way chat function. In other words, throughout the day, I am putting chat comments out to those customers that are signed, to those clients that are signed in. Our purpose in doing the Masteries program is not to tell you where to buy or sell. It's rather to help you understand the market. From time to time, in order to help you understand my thinking, I will share a trade. On the chat comment yesterday, yesterday afternoon, and I don't remember the exact prices, but I said that I was going to go delta short the market. Delta short doesn't mean you can be short with futures, you can do it with puts, you can do it with spreads. I did it delta short with put options. And the reason I use the put options are multiple. One, I have option. If the market goes down, I can just sell the puts, take a profit, or I can trade futures against those. So if I'm long puts, I can go long futures and I'm protected with the puts. So my position yesterday afternoon was long puts. The reasoning I gave was that the market really was stalling. It had very little lift. And as you can see, it just widens out. And this was sometime in the afternoon when this trade was done. I don't remember exactly when. But the market did provide a couple of opportunities to trade against it. The market broke, I think, down to the 27 area. If I remember, it went a little lower, but I believe the 27 area. And let me put that. That would be right there. So the market did break down to the 20, a little lower, almost a half back, and gave a couple opportunities to trade long futures. When the market closed, I'm sorry, so the first reason that I gave for being delta short was that the market really just was lagging. There was just no ump to it at all. So in other words, it had short covering, but it wasn't joined by new business. Additionally, with all this work that the market was doing on the upside, the best it could get was overlapping to lower value. And that's where we trade value, not price. So the market attempted direction was up. It's up all day long. The market fades. It just goes P-shaped. Value was overlapping to lower. So at that point in time, my decision was to be delta short with the puts. So again, monitoring for continuation also brought the trade to me. Now the trade was closed in the overnight markets. Closed it a little early, traded a little early, but that is the trade. So I monitored for continuation. That identified a potential opportunity for me. So monitoring for continuation allows you to see when the trade comes to you. Okay, now with that in place, now let's go and let's take a look at today. Today's overnight, coming into today, overnight inventory was short again. We put out a report each evening. Additionally, we put out an updated report in the morning prior to the opening. I was a little late getting it out this morning, but it usually is out about a half an hour prior to the opening. In that report, one of the first items it says another statement related to overnight inventory. And it said, if overnight inventory is short and the market doesn't correct that overnight inventory, then that's an indication that the market is weak, at least in the day time frame sense. Today's market did not correct overnight inventory. It was a sign of the market being weak. Now, once the market opens, I'm going to take out the overnight inventory for the other markets just so it doesn't, I'll leave last night's in. And now, when we're talking about monitoring for continuation, The market opened this morning. The first low on the market was a single, I'm sorry, I'm going to take out last night's inventory too. It's just going to make it easier to see things.
You can shut those time templates too, Jim. Thanks.
Okay. The first low this morning in A period was a single tick above yesterday's low. Anybody that's been with us for any period of time knows that we classify that as a weak low. A weak low occurs when a market, the low or high for the previous day is within a tick of the lower high for the prior day. So today's early low was a single tick above yesterday's low. That is a weak low. The market rallied, and it's unlikely that the odds are very low it's going to hold that low. The market rallied from there. It came back down, and it took out yesterday's low by a single tick and rallied again. It was still a weak low. Again, the chances were very good that we were coming back down through that low. As you can see, in A period, the market did come back down pretty sharply to that. So when we're talking about this idea of monitoring for continuation, understand that you have to be able to look at something far different than price. The structure is what gives context to price. So the short was there this morning. You actually had a couple of times to get that market short because of the trade at yesterday's low. Now, once the market broke, it broke an A period and B period, broke pretty hard. The chat comments that I put out, and they're all there for anybody that was there to see. The first comment I put out was, I said, it is just a feeling. However, the market feels, it just feels like what we're seeing is emotional selling rather than a combination of, liquidation, emotional selling, and really serious, more important type of selling. Now, that's, you say, well, what am I supposed to do with that? It's just a feeling, was my comment. Well, part of what I was looking at, there was an awful lot of single prints. And it just seemed to be too many single prints without seeing, pretty clear downside continuation from the market. As it turned out, it was a sign that the market was getting too short. I next put out and let me see if my screen cracked while I was on vacation, and sometimes it works. It's getting the computer's getting replaced tomorrow, so sometimes I may lose this in what I'm trying to do. But I want to go back and I want to see if I can get some graphics that I captured this morning. All right. I'm sorry, it's just so difficult with this machine cracked. It's hard for me to okay. Here's one of those graphics. And this is not in the order in which they happened. So excuse me, because I'll find the other one in a minute. The C period high was a single tick below the overnight low. the comment was that was on the chat room. That was a weak recovery high. And again, it was a weak recovery high because it was a single tick below the overnight low. Now, is that always going to work? No. But so much of what we're doing in trading is focusing on the odds. And the odds said the chances of coming back up through that were pretty good. Simply from it's a weak, and you say the thinking that you're trying to go through. And when we go through the Mastery Series program, what we're trying to do is help you know how to think about the market and how to think about the people you are competing against and those that are out there trying to take your money. Who sells exactly one tick below the overnight low? A very visual mechanical seller. It is usually the weakest hand sellers, a day time frame seller that is mechanically wanting to short every rally in the market because early price was down. Let's go back for a second. That price would have been 24.1575. If we go back over to the market, there is 24.1575, and you can see the market did come strongly back up through that level. Okay, let's see if we can find some of the other graphics that I'm looking for here. Okay, here's another one. Again, not in order, but we did go back up, take out that C period high, got into the overnight range, but this time the D period high is just a little short of the overnight of yesterday's range. Not particularly meaningful just yet. The point of control, I'm a little trouble operating. The point of control is where it's green. So that starts to give us something to focus on. The market had quit one time framing at this point in time because D period took out the C period high, stopped one time framing. So when that happens, we now start focusing on the point of control. So the point of control was just under the overnight low. So again, monitoring the point of control is one of the things we do in order to monitor for continuation. Okay, let's see if we can go find one more of the graphics that I want to show you. No, that's not it, sorry. Judah, do you see? Oh, wait a minute, here it is. All right, this actually would have been the first graphic I would have shown you. But if you look at C period opens, and one of the things when the chat comments, we're going out and we're saying, keep an eye on the clock, which is in the lower right-hand corner. Yours may be someplace different. But I always want to see what is the profile going to look like once the time changes. So in this point, the C period opens and the market immediately trades off. Now you have A, B, C sticking out there by itself and C period trading lower. So one of the comments that was on the chat comment, and these are all for those that are clients, they're all there. This is nothing cherry-picked. It's all happened this morning. I said it would be very unusual if you've looked at profile structures for any period of time. It would be very unusual to have that C period hanging out there simply by itself. So again, when you're monitoring for continuation or you're looking for a trade to come to you, This is when this hangs out by itself, C period trades on off. If you're looking for a spec buy, that is a potential spec buy. Don't ask me what's going on here. I'm telling you, my computer is very messed up. So anyhow, monitoring for continuation also may lead you to a spec buy. Now, let's say that you did a spec buy at that point. Let's go back to the market and let's see what happened. Okay, the market, this was the point of control originally, right down there, 24.1575. The market started to trade higher. It got back into yesterday's range. The first time it got into yesterday's range by a single tick. And we said, again, that was a weak recovery high. A weak recovery high because it went exactly within one tick of yesterday's low. So the chances of this being a good high were pretty poor. Now the market goes back up and F period takes out the E period high, comes back down. Now it's clean. Now it's taken it out by more. Now you got to be more careful. Additionally, the point of control was originally 24.1575. It moved up to 24.17, but it had a chance. It had a chance to rotate higher. When F period opened and trades down to this level, though my mouse is not working right now, when it came and traded down to that level, that lowered the chance of the point of control going higher. So the chance of having much upside continuation today has lowered considerably. And it's lowered considerably because the point of control, which is now the A, B, D, E, F, is now 5 wide. And it's not that it's 5 wide, but it makes it more difficult for the market to do much more on the upside. Because if you look, if the market did more on the upside, I'm trying to get my mouse back. It's not working because the screen is cracked. Let me see if I can. Julia, we may have to go to your screen. If I can't get this to settle down. Okay. If we can we go to your screen maybe? This is crazy. I'm not touching this, incidentally. The screen cracked. I've got a new computer coming tomorrow. And there's been a, I read on the internet, this is not the first time this is happening. Looks like HP tried to deny it the first time. Okay.
One second.
Okay.
Okay.
Okay, well, let me keep talking in here. Sometimes I've been able to work this in the right light and get it back. Well, window traders stop working now. So, Julia, I don't know if I can get to see your screen.
Yeah, sure thing. I'm taking it right now. I'm loading it right now. I just...
Okay. All right. So while Julia's doing that, what we're really looking at is, you see today, the market tried to go higher. We got some short covering early in the morning, but then when we got within yesterday's range, in one of the last chats I think I put out before we came to the webinar here, is if in fact there was anything on the upside, the market should get back into yesterday's range, and then it should start to show some upside acceleration. If it gets back into yesterday's range and fails to show that upside continuation, then you probably are not going, you're probably not going any higher today. The chances are that the market will then begin to rotate lower. And what we saw when we just left it, that the market had a chance to raise the point of control, but it was unable to do that. So now, okay, now we've got Julia's screen up in front of us. So you can, Julia, thank you very much.
Sure.
So you can see what we're talking about. We got into yesterday's range. I said if there's anything there, we should show, you know, we should start to get in that range and show some acceleration from there. We didn't. Is your screen move? Oh, there it goes. And you see that the point of control is down at the 24.17 level. If you will look in the right-hand corner of your machine, you will see that it is 9:26 my time or 12:26 out east. So what that tells you is that in 4 minutes, we're going to get another time change. And then we're going to see if the point of control raises again, or we're going to be 6 wide, and more than likely the market then goes into a rotational mode for today. So early on, when that C period was hanging out, if you took that as an opportunity to buy and monitor for continuation, once you got back into yesterday's range and didn't show upside continuation, that is, from an odd standpoint, that is the end of any long trade. It is also when you don't accelerate once you get into yesterday's range, that is also the place for a short trade. I mean, it's depending on what your motivation as a trader, but if you're a very short-term trader, that gives you an opportunity for a short trade. Then you would monitor that short for continuation. And to monitor that for continuation, you want to see the market stay below yesterday's range. You want to see the point of control begin to lower. And, and if it doesn't, then you just step aside. One of the things that will make you couple of things, let me just review. One of the things that I think will start you on the path to becoming a better trader is to understand that price is simply an advertising mechanism, and the structure of the market as recorded by the market profile. The market is a continuous two-way auction process. Every one of those auctions dumps information in our hands. The market profile allows us to organize those continuous two-way auction processes so that we can gain information. So the first thing in becoming a successful trader is to understand that price is an advertising mechanism and that the structure of the profile adds context to price. The next thing we look at is we say, okay, value. We saw yesterday the market attempted to trade higher all day. The best we were getting was overlapping to lower value. So that signaled to me an opportunity to be delta short. Now, if you look at that trade, price traded higher. Can you split out yesterday for just a second? Okay, so you see in the afternoon, after I did that trade, the market traded higher, 3 or 4 times. But at the same time, value was lower. So the price-based traders were buying every little break. I was just a little longer term, willing to take a option trade home overnight, and I'm seeing the market as weak. So you get that difference. But if you're only thinking price, the market looks pretty strong to you. If you're looking at value, which is overlapping to lower, you're looking at the P formation, which just means the stem of the P, and then you get the loop at the top. That's just an indication that what was going on through most of that day was what we call old business. It was shorts covering versus a combination of old business and new business. A combination would show you a more elongated profile. Then we talked about the importance of understanding overnight inventory. Yesterday, overnight inventory was short. The expected reaction when the overnight inventory is short is for the market to squeeze that short and trade back through it. The unexpected, and we've looked at this, and I think we've got odds about 65% of the time, you will see a counter auction or a correction to overnight inventory. And when you don't see that correction, as you did this morning, then that's an indication that the market is weak. If you were just following price this morning, you could have gotten sucked into buying as the market opened. But if you were looking at the profile and the structure, you saw that the first early morning low was a single tick above yesterday's low, which structurally is very weak. You saw the second pullback, the market dipped down before it rallied, was a single tick below yesterday's low, and it rallied again. So ask yourself, who's doing that buying back there? Those are price-based traders that really don't understand what we're talking about. So they are excited. They are trying to buy as close to yesterday's low as they can. We're sitting out there and saying, what they think, they're delighted that they bought within a tick of yesterday's low, either one tick above or below. They're delighted thinking they got a great fill. We're sitting here saying that is an indication to us that the traders that only buy, they'll only respond to the opportunity if the market, is within a tick or two of yesterday's low. That is not a strong buyer, and that is not a buyer that is likely to be able to carry this market higher. And we saw on both times, you got a little rally out of it. Both times the market came back down through it. So structure was very helpful in understanding and appreciating what was happening. If you were mesmerized by price, then it's very difficult to trade. And I can remember so many times as a trader over the years, before I really started to understand structure, getting sucked into price. And I can feel times the market start to take out yesterday's high or low, and I said, boy, it's going. And I'd get in there and I'd end up owning, the high or the low for the day or within a tick or two of it. And because I really was focused on the wrong thing, I didn't appreciate what was going on. Once I started to put structure to the market, it is much easier to understand. The next thing that if you're going to be a successful trader, in my opinion, you have to get to the point where you are willing to forego a trade. Too many times, traders come in and they are too anxious early in the morning. They are just wound up. They are bound and determined, we're going to trade today, and they're so afraid they're going to miss the best trade of the day. And once that attitude, once you have that, and once you feel that pressure, you are more than likely on a losing course. When you're going to be a successful trader, you have to be willing to miss a trade. So what? Guess what? I missed this entire rally yesterday morning. Okay? I missed the entire rally. Even though I was looking about it, kind of wrote about it, I missed it. And the market started going and I wouldn't chase it. And years ago, and unfortunately it wasn't that many years ago, I would have carried on all day about, I missed the best trade of the day. And somehow, a few years ago, all of a sudden, I just woke up one day and I was just able to let it go and go on to the next trade. And as you see, I did that. I went on to the next trade late in the afternoon. Trade worked out. It gave me some trades against it. It gave me a nice break overnight. It worked out very well. But again, I didn't let the first trade get to me. That control of emotion is so important in you becoming a trader. You have to be willing. You have to be willing to sit for a long period of time until the trade comes to you. And you have to be willing to say, if I missed it, I missed it. Okay, I've talked a lot. Let me open this up for questions, please, Julia.
Okay, great. Just to confirm, you said you closed your puts out overnight, and he said how, and I just said, E-mini futures options trade all night. So just to clarify, it was overnight. that you close.
They do. They trade almost 24 hours except for Saturday and until 6 o'clock Eastern time on Sunday.
Okay, and there's a question that the F period high, isn't it weak because it came close to today's open?
No, I don't use, and maybe I'm wrong, but I really don't put any real thing on today's open unless it's exactly at the open. If it's a tick or two either side of the opening, then I do. But this is that 3 ticks on your machine? I think it's 3 ticks below. So no, I didn't pay any attention to it. But you may be right. You may absolutely be right. But I didn't pay any attention. Now, when I look at this market in front of us, the market did trade off. And we talked about it, it got 6 wide down there. But keep in mind, it still has a potential, to widen out as time goes on this afternoon. The other thing, Julia, if you can show me, can you take the overnight out of there and let me see this market without the overnight? Because there's one other important factor here.
I can collapse yesterday too, right?
That'd be great. Okay. Here's what we're dealing with. You can see we've got a 1, 2, 3, 4, 5, about a 7 or 8 day balance. The low of that, if you can mark the low of that balance from, I think it's on 627. No, I'm sorry. The low of the balance, I'm sorry. Take the low of the balance from last Friday. So we have Friday, Monday, and Tuesday. So it's an area, can we break below last Friday's low and start a new leg to the downside? If not, the market can rally. Additionally, if you take a look at yesterday's profile, you have a very wide POC up there to 24, 27, 75 level.
Well, 24, 28, 50. That's the settle or the close.
Okay. Okay. I was looking at the point of control. I'm sorry. 24, 28, 50. It's very wide. The market can get drawn back to that. What it tells you is this wasn't any, high confidence break. But additionally, if you can go up and show the highs, I want to point something else out up here. Okay, if you will look at the high that Julia just mentioned from July the 3rd, you will see that it has no excess. Oh, I'm sorry. Yes, no excess on it. In other words, there's no single prints. So we are looking at that's considered a poor high because there are no single prints. If you will now go look at the high from 629.
Well, 628, you mean?
No, 629.
Yes, that's weak.
The high from 629 is not poor because there's the single prints, but it is weak because it exactly matches the poor high from 628. So, and then if you can take a look at the all-time highs up here, you'll see on 626 that we also have a poor high, and at the all-time high we have only 2 ticks of excess. So what I'm showing here is the odds that we don't have. We have a market that's been selling off a little bit here. We saw it again last night, but we don't have a market up here that says final, we have the high for the all-time in this market. I think the odds are extremely low that we have seen the all-time high for the current rally. I think these combination of poor and weak highs also lower the odds that the market is going to be able to trade down with any great conviction. Now, it does happen, but I'm simply talking from an odds standpoint. So that has to be brought back into the picture. You have to bring back in that if we can get by and find acceptance back again above Friday's high, which I kind of look as a little balance area, then this market can move higher. Okay, let's open for questions, please.
You just said Friday's high. You meant Friday's low.
Friday's low.
Yeah.
Yes.
So this is a go, no-go level, so to speak. Yeah. And we're hovering around it now. The question is coming up that the G period low is so close to the F period low. Would you consider that weak and that it's vulnerable, to the downside, that it could come back at it?
Very much aware of it, but one of them like that does not get my attention. Where they get my attention is where you will have 3 or 4 of them within a tick of each other. That's when we start talking about the potential of the firecracker effect on a break. Can you go over and split out 629? Oh no, maybe not. I'm sorry. 7.3. Okay, if you look at 7.3, you'll see that the B, C, D, E, and at one time, the F period was 1 tick above the E period. And when I look at that, I say, okay, that's where you have the potential for what we call the firecracker effect. So the market is trying to trade higher, and you've got the price-based buyers are buying it in A period, they're buying in B period, they're buying, and look at the B period low is just a tick above the opening. So again, who buys exactly at the opening or a tick above it? Those are usually weekend traders. Then they're buying C period, D period is close to the C period as low as possible, E period a tick above D period, and F period when it first opened was a tick above E period. I remember looking at the time. That, when I see that formation, price is taking the market higher, but I'm looking at that formation and I'm saying, what is going on? What is going on is that weak hands traders are getting longer and longer and longer. And as we get near the close, they're forced to liquidate. We saw this. I had a membership on the Board of Trade as well as Chicago Board Options Exchange in the early years. In fact, I was the last signer on the first page of the book for the CBOE. But you saw on the floor of the exchanges when the larger traders would realize that the smaller traders in the group had gotten long, such as we see on 7.3. All of a sudden, as the larger traders recognized that inventory condition, they would turn palms out. When you're on a floor, palms in meant you were buying, palms out meant you were selling. So the larger traders, when they saw a condition, like we can see it here in picture, they felt it in the crowd, all of a sudden they would offer everything. And that would get the small traders, that would get them panicked, they'd run for the cover, and you got a liquidation break. And normally that's all it was. But again, that is something that you have to be aware of as you're looking at the markets and saying, what is really going on here? What is the chance that we're going to get that? Well, we call it the firecracker effect because, taking out one low triggers the stops from the next low, et cetera, and it's like setting off, not tearing the string of firecrackers apart, but setting one off and it sets all of them off eventually. Okay, additional questions?
Yes, and I don't know if you said that, you wrote this in the chat on Monday, the mastery program chat, that are we going to see a liquidation?
Oh, yes, I did. As I remember now, there was 53 minutes till the close. And what I wrote in the chat, I said, I remember the words, it wasn't a prediction. It wasn't a prediction, but I said the final question, something like that is, will we get a liquidation break as we near the close? And 10 minutes later, that got underway. Did I know it was going to happen? Absolutely not. Did I know the potential for it to happen? was very strong. Yes, I did. And again, when we're talking about odds and thinking, what would it tell me? The first thing it would tell me is I wouldn't be long for anything. Now, whether I go short's another question, but so many times the importance of knowing how to monitor for continuation, look at the market, is knowing what to stay out of, when not to be long or when not to be short. That is a huge start in order to build a profitable portfolio. Additional questions, please.
Yes. Were there, with the several rotations through the open early in the day today, was this an indication to you of a potential rotational day?
No, not at that time. What it was, because, I mean, I was watching it very closely, and what it was an indication to me that there was mechanical buying by the weakest hands traders at the, as close to the opening, as close to yesterday's low as possible. So I'm saying, okay, inventory, they're not going to correct overnight inventory, and the inventory is getting longer because these weaker traders are buying it. And that point in time, I did note in my head that if the market was truly weak and you had, really institutional money selling, you more than likely, you open and you go lower pretty quickly. But I ran an institutional desk at one time, and so you got to be a little careful. It wasn't uncommon for institutional orders that wanted to be entered at the opening to tell us, wait, they didn't want to go in the first 15 minutes. And the reason they didn't want to go in the first 15 minutes, they didn't want to be sellers, for example, and find out that there were buyers in that market. And, then they end up, selling at the low for the day. So sometimes they would wait 15 minutes just to make sure there was no big buying in the market if they were sellers. But it did go to my mind that if it was truly longer term or institutional selling, it would have gone right away. But we haven't seen longer term money in this market for a long time. They're not dominating. What we've seen is trading money. Now you've got that into two categories. You've got the very weak day time frame traders, but then you've got huge pools of money that are short-term traders, but they're just one step beyond day time frame. They will take trades home overnight. They are highly leveraged. They have good capital, and we've seen them be very active in the market. But that is different than I haven't seen any indication of serious longer-term institutional money on either the buy or the sell side. That doesn't mean they don't mix portfolios. We've seen it in NASDAQ. We've seen it in NASDAQ on the FANG stocks, the Facebooks and Alphabet and all those kind of stocks. We've seen it in there. But as I've been writing that, and maybe that is an important thing to cover, what I've been writing, it is not uncommon to see the more speculative index, which is the NASDAQ, lead going up, and it's not uncommon to see it break first and break pretty hard because it's more speculative, it's overextended. It's not uncommon that the stocks in the NASDAQ are very often growth stocks. And the economy, if you look at the economic numbers that have been coming in, they've been on the soft side. So when the economic numbers are on the soft side, it's not uncommon to see some movement away from these high multiple growth stocks into what they call, safer securities. We'll see if that's really the truth. But so it's not uncommon to have the NASDAQ break first, have the Dow become stronger because people are going to what they consider to be more defensive type of stocks. But when it's all said and done, what usually happens is they all fall together. It may go NASDAQ first, holding the Dow, then they all fall together. I don't know if that's going to happen. That is a phenomenon I've been watching in here. We also, as I've been pointing out, for a long time, you could look and see, and people really didn't, stock buyers didn't care much about bonds. But do you have a bond chart, Julia?
I can load one.
Load one, please. Appreciate it. What we've seen recently is there's been pressure on the bonds. And remember, there's an inverse relationship between the price of bonds and yield. So as bonds go down, yields go up. And stocks, particularly when some of the economic numbers have been on the slower side, we have seen more pressure on bonds. And if you'll take a look today, I think you'll see that the bonds gapped lower this morning. And when you, in the report this morning, the last thing, as I said, we put out a morning report. The last thing I put in the morning report this morning was bonds, because I thought there was a pretty good chance that that the bonds, and you can see the overnight trade, and then the bonds gapped lower. Let's see what today's low. There's we're trading right now. Yeah.
Right.
So there's the gap. So again, I think that short-term traders are looking at bonds and yields. So I think that influenced the market. For a while, they got influenced by crude oil. Now they're getting more influenced by the bonds. Yields go higher, they're more nervous. Okay, additional questions?
Yes. The monthly chart has stopped one time framing higher. How significant is this?
When did the monthly chart stop one time framing higher?
Are you talking about bonds, Jack? Oh, I'm sorry. He's saying the NQ. I'm sorry, Jack. He wrote it. The NASDAQ monthly chart.
Oh yeah. As I say, it's not uncommon for the NASDAQ to break first. When you look at the monthly, weekly, and daily of the S&Ps, what we see is the monthly, if this is the 8th month, that it's still one time framing higher. And when we do our reports as part of the Mastery series, the first thing we always show is the monthly. We want to have a broader perspective. Now the weekly shows a different picture, and the weekly will normally turn, and you get an indication before the monthly. So the weekly has stopped one time framing, and the weekly now is showing a balance. So we're getting a different message from the weekly than we're getting from the monthly. Right now, and we're also, all the charts that we put out, we have marked the 2400 level. Just because that's, you'll see it on the charts, 2400 level. And you'll see that last week you had, I think it was last week, you had that big break in the market, and the break went down to, I think it was 2402 and a fraction or something like that. So it was a mechanical bounce off of the 2400 level. And it's a mechanical bounce or a psychological level. And we know, because there's so much trading, psychological numbers are important, particularly for short-term traders. Okay, a couple additional questions.
Sure thing.
I'm sorry, what Julia is showing, Julia, go back to that for a second, if you would. What Julia is showing you is a sample of the charts that we put out as part of the Mastery program. And we've been doing this in between the two programs. But you'll see what we're looking right there. And just see a bifurcated market with one distribution at 2400 above and a second at 2400 and below. And you see that we have a tight little balance in there. All we're trying to do with this is start from the top down, and then we get down to the daily profiles, then we start to build at least 3 scenarios for the following day. The worst thing that can happen to a trader is they only have one scenario in mind for any particular day. The trader that has one thought only has a very difficult, when he makes money, he'll make a lot of money. When he's wrong, he'll be wrong very big, and he or she will not have the mental flexibility when things change very quickly, which they can in markets. And so it's very important how you do these reports. Okay, additional questions?
Yes, Jim, since there is a 97% probability to break the initial balance high or the initial balance low, and you are not looking for continuation, are you now looking for a break of the initial balance low and have ruled out the initial balance high? And initial balance is the green line, which is the A and B periods entire range. The first.
Okay, I don't know. I have no idea where 97% came from. I don't think it's a number I put out. I no longer use initial balance anymore. today it worked out. It is A and B, but I'm basically looking more to see, do I have a base that's very short? In other range for days, it's very short and narrow and likely to get knocked over, or is it bigger with less likelihood of getting knocked over? But I don't use initial balance anymore, and I have no idea where 97%
I've
came
heard
from.
that number, but I don't know where. The stat is well known from, futures trader 71. So it's someone, I've heard that number before, but it's.
I'm not sure what value is to me. Okay, what else we got?
I'm calling up the report here because we have a trader asking, would Jim consider today's breakdown a breakout of the short-term balance here? Let me make it a little bigger, highlighted in the daily report. So, shown on, if so, does that target the 2400 level? So let me just go back. You're all seeing that short-term balance, but this is the short-term balance here, and it looks like it's a breakout and fail right now, right, Jim?
Yeah.
I mean, we're not sure.
It's a little early. The balance trading rules are break out a balance and go, look above or below balance and fail. And so you've got to be really cautious. This is not a clear breakout to the downside. Now, understand also that tomorrow we see the monthly employment report. And I've said this over and over again. The monthly employment report generally has no effect on the longer term investment money at all. The monthly employment report is something that's hyped by all the news stations and everything else. And bet on this, and if you get it right, you get a t-shirt or a hat. And it's a hyped number. It has very little impact on the real market. The numbers that count, at least in my opinion, are the serious people that are looking at these numbers. They are taking and just compiling the weekly numbers one at a time. They may not rely on any one weekly number, but they're compiling the weekly numbers one at a time in order to get a better perspective of what is truly going on. Okay,
Jim,
let's do a couple more questions.
Yesterday, did you notice that the price action was jerky and not smooth? And is this an indication of short-term traders, or am I reading too much into it?
No, perfect read. No, it was jerky. It was heavy. It was just, there just wasn't any real fresh blood in there. So you had short-term traders just, trying to buy every little dip, and they weren't getting much, and they got longer and longer and longer. So your observation was a good observation. Okay.
Do you put any significance at the poor high and / low that aren't the actual high or low of the day? For example, today's 2420 level and then the 2419.75 touch, just one tick below. Is there anything to be gained from that information?
I'm sorry, you have to repeat that.
Do you put any significance at the poor highs and lows, like that they're not the extremes of the day, but say this G and F, it's the G comes within one tick of the F, and someone asked it on the downside earlier, or just a tick below, the low of the day, okay. There's a poor
so
high low.
In other words, the rally high, yes. When I do, somebody asked about the FG low, and I don't pay much of attention when it's just one. It could be a coincidence. I said it needs to be multiple. So I am paying attention to the EFG highs. They're not the highs for the day, but they are the rally and recovery highs. And I think the odds are low that those will remain as our highs by the end of the day. Now, keep in mind, we just changed time periods, just started a new period. It is possible to raise the point of control. And what would it take to raise the point of control? There's two things. It could spend time up here, or you could get range extension. The point of control right now is where it's green. Julie will show you down there where it's green. That is the current point of control. But the point of control can go higher today if we spend more time up here or got meaningful range extension. But no, the EFG highs, to me, those are weak mechanical sellers selling as close to those highs as they can get. And they may last, but I think the odds of them lasting are low. What I was going to say earlier, that this is a difficult day. The day before the employment report is a difficult day because any longer term or investment money or longer term traders that wanted to make any adjustments prior to the number probably made those adjustments yesterday. They normally make them a couple days ahead of time. And so on a day like this, prior to that day, a lot of the larger traders are sitting on the sideline. So this is a day like this has left a lot of time in control of the shorter term traders. All right, we're at the hour. We got another couple of questions.
Well, yeah, we should wrap it up. But does Jim take trading during thin holiday weeks like this week, Thanksgiving, Christmas, with a grain of salt, or does he treat the action during these weeks just as he would with any other week?
I do not take it as a grain of salt. Am I aware that the markets are thin? Did I write that in the reports? Yes. But that sometimes will give you an opportunity. You saw the opportunity it gave me yesterday. As you know, and like I say, I only talk about this because I put it out on the, on the chat. So if the market gives me an opportunity, I'm a short-term trader. I'll take it. And sometimes in these weak markets, they can get overextended either up or down. And if they give me an opportunity, I'm more than happy to take it.
Right, not weak markets necessarily, but thin markets. There's just not as much liquidity.
Yeah, but that can offer, as long as you understand that, it can offer opportunity too. Okay?
Okay. All right, great. How about for a last question? When you talk about current business, what is the meaning of that in terms of the market has to take care of current business first?
Oh, great question.
Yeah, so let's end with that one. Thank you for the question.
So the bonds gapped lower, and as you see the report I wrote this morning, the last comment on the report is about bonds. And the reason it's there, knowing it's a thin market, it's not uncommon. They say, oh, okay, they get all spooked because bonds traded lower and they want to liquidate. Well, the current business is that shorter term traders are made nervous by the bonds being down. They're going to sell, and so that's current business. They're reacting to a short-term event, and that's going to, more than likely, that's going to occur before anything else in the market. And that's what happened today. I didn't put that it was going down there. I just put the last thing on it, the note of the bonds, because I had seen it, and it caught my attention. All right. So at this point in time, we start the new Mastery Series on Monday. If you're thinking about it, we'd love to have you. The commitment that Julia and I can give you is that we have 100% commitment to the program. We do a webinar each morning. That's about an hour to an hour and a half to get you oriented for the day. The chat function is fully operational throughout the day. I'm making one-way chat comments. The reason they're one-way, because a lot of traders, if it was two-way and people are asking questions on the chat and answer, they'd get lost and they don't have the time for all the questions. So all they're getting on there is the one-way chat. Now this morning, I got a question from a client that was a very good question, and the email I sent back to that client was, see the chat will be the next comment, and I put that comment in the chat and then I answered it there because it was a good question. So we try and be responsive. So you're going to get an hour to an hour and a half webinar in the morning, get you oriented for the day. We will do additional webinars from time to time if there's something important. For example, when the employment report is coming out, we usually open the market a couple hours before the opening. We follow the trading that takes place in the electronic market after the release of the jobs report, because we have found that there's some pretty good information in there relative to what will happen for the remainder of the day. There is a recap and preparation report at the end of each day. Last night's recap was pretty long, a lot of steps, taking people through exactly what I was seeing in the market and why for some of my actions. Sometimes it's shorter because there's really not that much to recap, but there's a lot to learn from that to show, just thought process step at a time. The reports, they start with they go monthly, weekly, daily bars, which top down. We always start top down in order to broaden your perspective. Too many traders have, when the day closes, they're too narrowly focused and they miss some of the bigger, more important things going on. And then if there's anything significant overnight, we'll cover that in the morning report. There's always a morning report to bring an update. And then, of course, Julie and I take questions. We hope you join us. And as I say, if you do, you've got your commitment. You got our commitment. We will give you everything that we've got. Thank you much. And I hope to see a few new names coming up to join us on Monday. Thanks.
All right, great. Thank you, Jim, and thank you, everyone. Thank you for the questions and comments. Always helps us. We will have the webinar up at jdaltontrading.com in a couple hours. And please stay in touch if we can answer any questions for you. And if we don't see you again, have a wonderful summer. Okay, take care of yourselves and good trading. Bye-bye.